Center. The Mishra Center undertakes research on financial markets and the economy in the Indian context, but usually with the global markets as the benchmark. It addresses issues such as formulation of policies, market structure, regulations, real estate financing, commodities, banking, bond markets, fintech, financial inclusion, insurance, monetary policy, fiscal developments, and related topics. So we facilitate research by IIMA faculty and doctoral students working on finance, economics, strategy, and related areas. We also engage with relevant regulatory authorities who influence policies, as well as industry bodies and other stakeholders who are significantly affected by policies. With that, let me give a very brief introduction to Dr. Kevin Gam. So Kevin is an assistant professor of finance at UCD School of Business at University College Dublin. He obtained his doctorate in finance from Washington University in St. Louis. And prior to his academic career, he has worked in the Financial Supervisory Authority in South Korea. And he holds an MBA from UT Austin and a bachelor's from Seoul National University. And his research is in the fields of banking, financial intermediation, and corporate finance, with a focus on financial stability and credit markets. So with that, let me hand over the floor to Kevin. Kevin, the floor is yours. And for the audience can ask questions in the chat window, and Kevin will take the questions at periodic intervals. Okay, over to you, Kevin.
All right. Okay, thank you very much for a great introduction to me. So first, let me share the screen. All right. So can you see the screen?
Yes.
Okay. All right. Yeah, thank you very much for inviting me virtually to the Mishra Center for Financial Market Economy in Indian Institutes of Management, Ahmedabad. So this paper is a banking empirical paper, and this paper is joint to work with Professor Songjin An in KAIST, the Korea Advanced Institute of Science and Technology in South Korea. And this paper, we talk about how the bank's behavior or reporting pattern of their problem loan can be differentiated depending on the bank's existing asset quality. So our starting point, the research question and motivation of this paper is quite simple. So if the banks face some negative shock on their asset quality or the solvency status of the local borrower, what will be the best response of the bank? So that is quite simple question. And there may be different many scenarios, but we can think of broadly, we can think of two possible optimal response of the bank. The first one is, as usual, or following some best practice or following their internal regulation, banks just strictly assess the risk of the affected loan and manage the risk of affected loan. So that means banks actively and aggressively recognize additional problem loans and loan loss provision, and this actually eventually clean up the bank's potential toxic asset from the balance sheet. And this also enables the banks to survive potential future banking crisis in the future time. So this is kind of bright side of the very strict management. However, there is some dark side especially in short run. So that means banks have to report more and more problem loan in their financial statement. Also, the bank have to recognize more and more loan losses in their income statement. And this actually worsens their financial ratio. For example, NPL ratio should go up, and capital buffer, capital ratio, and other profitability index should go down in the short run. And those information actually disclosed to public. So the stakeholders and market participants also identify this worsen the financial ratio in the market. So this kind of information can be taken as really bad signal by the market participant for the bank's riskiness. So this may trigger some market discipline. That is a kind of dark side of this strict management. So for example, the large depositor may reallocate their money from this bank to another bank because of the concern of the bad financial ratio. And also banks may have more trouble in rolling over their current debt in the financial market. So if banks really concerned about this kind of market discipline, banks may choose another option. That is just intentionally underestimate some of their the severity of negative shocks. So that means usually banks asset, some of them is good asset, some of them is bad asset. But in between, there's some gray area. So those are not very clear. So in normal times, those kind of gray area are more likely to be classified as a bad loan. But in these cases, banks are more likely to have a high incentive to reclassify those gray area as just a normal loan. So as a result of that, banks can maintain their financial ratios. Banks does not need to report more problem loans, and those actually help in maintaining their current financial ratio. This can relieve some concern by the market participant, and this also reduce the likelihood of market discipline. However, that is good side, but there's another problem. That is, banks still hold a lot of bad loan, potential toxic asset. Those are actually hidden as just a normal loan. And if the situation is good enough, then those kind of things okay. Those potential toxic asset hidden as a normal loan can be resolved in the near future. But if there is another very unexpected things happen in near future, the unexpected financial crisis occurred, then the banks also have to face another emerging toxic asset. Then banks, those emerging toxic asset and also existing hidden toxic asset altogether makes reason the bank survivor in the future. That is another kind of dark side of this approach. So both approach actually have a both bright side and dark side together.
So Kevin,
our question is, yeah.
There is a question on the type of shock in the chat window.
Okay. So shock is not clear whether it is asset side or live side. Okay. So in our paper, so in this question is a kind of asset side shock, but later I will talk more details about what kind of shock I use in our empirical setting. So that is shock on asset side. Especially we use a natural disaster shock, and that is shock on asset side, asset quality shock. So that is our setting. So on asset side shock for bank is economy-wide shock. So yeah, economy-wide shock also affects banks in general question. So in our cases, we use more micro level data set. So we just use a local natural disaster that affect only local banks asset structure. So that is our empirical setting. So I will talk more details about that later in empirical methodology part. Great, thank you for the question. So our question is, what kind of option the banks choose? The answer is, it depends, depending on the bank's situation. So bank's circumstances, situation. So then the other question is, what kind of factor and what kind of circumstance differentiate banks' response to the shock? So this is not a new question. This is a really old question. So old papers, existing paper already answered this question. So those papers highlight the importance of capital ratio, capital buffer, or the bank's profitability as an important factor that differentiates banks, the risk assessment or accounting management. So for example, capital buffer cases, that is one of the most important the financial ratio in banks. So most countries have a minimum requirement of the bank capital regulation. So if the bank's capital buffer is less than, capital ratio less than the minimum requirement, there should be some very strict corrective action can be imposed by the regulator. So because of that, if the bank's capital buffer is not enough, then banks have a high incentive to boost their capital buffer by managing their earnings or managing their losses. And profitability also quite similar. So if the profitability is quite low, that may negatively affect their bank's the stock prices, and that also affect the extra compensation. Because of that, if the profitability is quite low, then banks have high incentive to boost their earnings and also managing their losses to boost their profitability. Okay, so another. Okay, okay. So this is all the question, and our paper is our paper's difference is we choose another factor. So that is NPL ratio. That is non-performing loan ratio, and see whether this NPL ratio, that actually quite simple measure that capture the bank's overall asset quality, loan quality. And we see in this paper whether this factor also differentiate banks' behavior, especially loan reporting pattern in response to the negative shock. So then, so based on to resolve this, to answer this question in this paper, we employ a natural disaster as a shock. So we pick the natural disaster as an exogenous shock and negative shock on asset quality and also solvency status of local borrower. And our main finding is that if the local bank faces a local natural disaster in local area, then the local bank with high NPL ratio are more likely to report fewer problem loan. That means they underreport their problem loan after the shock. That is our main finding. And how to underreport their problem loans. So there may have different story, but our argument is that those behavior is most likely to be driven by banks' accounting management and use of discretion or evergreening. That also evergreening means that just keep making credit to the insolvent borrower or zombie borrower. That also can be included in this accounting management, accounting discretion. But there's another kind of method is just real management. That means banks, after the shock, banks just expand their safer loan, suddenly change their asset structure and lending structure. So instead of the riskier loan, banks just expand safer loan, or banks just purchase more and more government bond and treasury. Those kinds of assets are less likely to go bad in near future. Because of that, banks can reduce their NPL ratio by doing that. But we cannot find any evidence that banks use this kind of real management or asset structure change or lending structure change to reduce their reported NPL ratio. And another real management is banks just use a charge-off. That is just to remove their NPL, their toxic asset. Then in doing so, bank can reduce their NPL ratio. However, still we cannot find any evidence that banks use more actively the loan charge-off to reduce the reported problem loans. So that means our results are most likely to be driven by banks' accounting management or use of accounting discretion. So our paper's main finding is banks' NPL ratio or just the loan quality index itself was quite important, underlying their use of accounting discretion to report the fewer problem loans following the negative shock on their asset quality or borrower solvencies. So I briefly summarize some literature related to our paper. So the first strand of literature is about the accounting paper, especially accounting management, earnings management for the banking sector. Why they manage their accounting number or earnings? Because capital ratio and earnings, that is the main finding of the existing paper. So the BT Real 2014, that is a review paper that actually includes most of the papers that address the question of why banks manage their earnings. So capital ratio, earnings, so some example is here. So for example, so all of these results are related to the bank's capital ratio and earnings. So for example, Moyer 1990 paper. So long time ago, before 1990, I also learned from this paper that loan loss allowance also included as a capital buffer at the time. So because of that, if a bank's capital ratio is not enough, then banks are more likely to increase the loan loss allowance. But after that, after 1990, the rule has changed. So loan loss allowance is no longer no longer be included in the capital buffer. So after that, banks' behavior regarding loan loss allowance changed after 1990. That is documented in Metaket and Thomas 1999 paper. And most recently, the Bagli, Fernanda, and Yong paper, 2017 paper, that also quite related. Based on bank's capital ratio, the bank's calculation of the the regulated capital or the risk weight also can be affected, changed, especially in the trading set in this paper. So all of these papers are related, talk about how the capital ratio or the profitability affect banks' earnings management or calculation of the risk weight and so on. Our paper contribution is to pick another ratio. After controlling for banks' capital buffer and the profitability, we find that NPL ratio also is a very important indicator that also affects banks' behavior, especially the reporting behavior of their problem loans in response to some negative shock. So that is our main contribution. Other paper, related paper, is about the zombie lending of the bank. So zombie lending means the lending to insolvent borrower. So the best practice is if the borrower become insolvent and low quality, the banks need to cut the relationship, the lending relationship with the borrower. However, in the real world, especially during the market downturn, you can see there are so many zombie lending. Even the banks also keep making credit to the zombie form or insolvent form. Why is that? So that is another important question. And many papers already document this issue. So the reason is quite similar. That's because also capital ratio. Because banks' capital ratio is not enough, then the banks is more likely to keep making credit to zombie lending because they avoid they want to avoid some realization of losses from the zombie lending. Because of that, they keep making credit and try to keep the capital buffer. So that is existing paper story. And our paper is highly related because our main finding is the banks with high NPL ratio are more likely to underreport their problem loans. That means some of their problem loans can be hidden as a normal loan, and that hidden problem loans actually the zombie lending. So our paper also show that the NPL ratio itself or asset quality index itself also important factor that making zombie lending, that makes zombie lending. Right, so so I just briefly introduced some of the definition used in our empirical paper. So first one is non-performing loan, so NPL. So that is just bad loan. In other way, we can say the non-performing is a bad loan, but the precise definition of NPL is the loan with overdue payment of interest or principal more than 90 days. That is NPL. But although the overdue payment is less than 90 days, if the loan is regarded as really seriously worsened, then the loan also can be classified as an NPL. So that is NPL, a bad loan. And the other definition, the other term is non-accrual loan. So non-accrual loan is using some the accounting terms. So in accounting basis, there's an accrual basis and cash basis. So accrual basis means that banks doesn't need to check the cash flow itself. Although without checking whether the borrower indeed paid the interest to the bank or not, banks just recognize interest income just on time. So that is accrual basis. And that kind of loan is accrual loan. But if the loan is really serious delinquent, then the banks have to check whether the borrower indeed paid the interest to the bank. So only when the cash is collected, then the banks can recognize the interest income. That is cash basis. So if the loan is really bad loan, then the banks have to check the cash collection, and then the banks can recognize the interest income. Those kind of loan is called non-accrual loan. So that is also another way it's just bad loan. But NPL and non-accrual are a little bit different, but highly overlap each other. So we use these two definitions together, two variables together in our regression. The next one is delinquent loan. So that is kind of early warning. So that is loan with the overdue payment of interest or principal more than 30 days up to 89 days, up to 90 days. So this is not bad loan yet, but is have a possibility to become the bad loan in near future. So those kind of loan is called delinquent loan. Next one is loan loss provision. So that is expense set aside as an allowance for uncollected loan. So for example, among the 100, so 20% is looks like not collectible, then the banks recognize the 20% as expenses. So that is loans provision. And charge off, if entire loan is not collectible, then entire loan just book off, written off from the balance sheet, that is a charge off. Okay, so there's another. Okay. Okay, so India, the bank record interest on cash basis only after the loan become NPL. So I think the similar, yes, that's I think only after loan become the NPL. The same, okay, so bank needs to study. So I think definition is correct. So become the NPL, but NPL cases, NPL also includes both, so accrual loan and non-accrual loan. So although the loan, the overdue of payment is more than 90 days, some of the loan is still accrual loan, but these are included in NPL. So NPL is not accrual, it's not exactly same each other, but highly overlapped. So one thing that overlapped is the accrual loan, but overdue more than 90 days. So some of the NPL still use accrual basis instead of cash basis. I think that is a small difference between the NPL and non-accrual loan and also Indian cases. Okay, so I also introduced some data sources, used our paper. So one of the important data is natural disaster data set. So we use the data set from the FEMA, the Federal Emergency Management Agency. That is the US data set. So our empirical paper used the US data in our study. So FEMA is a federal agency. So the FEMA's main rule is to propose the declaration of the emergency to the president, and the president declare emergency after the proposal from the FEMA. So if the damage is really big, the damage of the natural disaster is really big, bigger than the capacity of state government and local government, then the FEMA asks for the emergency declaration, then FEMA actually gives support to the local government. So FEMA natural disaster, actually the disaster subject to emergency declaration. So that actually is very severe disaster. So that is our main data set used in our paper. And another one is shared data set. So as a robustness, or we also try to sort the sample into more severe and less severe. So by using the monetary damages. So shared that is a spatial hazard event and loss database for the next stage. That is called the shared data. And shared data, actually we can identify the monetary damage of each disaster. So using that, we sort the sample into two parts and see whether the underreporting pattern of the bank actually more severe if the disaster is much more severe. Okay. Okay. And another next data source is the bank financial statement. So that is the most important part because NPL, non-accrual, or delinquent loan at any other variables come from this financial statement. That is come from core report. And most recent paper, recent data set is coming from UBPR, Uniform Bank Performance Report data set. And in this paper, we limit sample to local bank to very clearly identify the effects of local natural disaster on the bank level reporting behavior. So we following some other literature, we define a local bank. So if the 65% of the bank's entire deposit is coming from one single county, US county, then we define that bank as a local bank. So to identify local bank, we use a summary deposit data set from the FDIC. So this summary deposit, from this data set, you can identify the branch level deposit. So we can identify how much fraction of the deposit come from a certain county for each bank. And then to test the real management. So to test whether the bank actually changed the asset structure or lending structure, we test based on the mortgage data and the small business lending data using the HMDA and CRA. Okay, so that is our main data sources. Okay, so this is our empirical methodology. So basically, we use the threefold differences specification. So we have three dummy variables: treated and high MPR and post. So this is a triple interaction term, and alpha 7 is our main coefficient. And I will talk about the definition of each dummies on next slide. And for this test, we construct a 2-year window. So 1 year before the disaster and the year with the disaster. So we compare only the outcome variable just within the 2-year window. And then we sample the local bank and we match the high MPR local bank and the low MPR local bank within the same local area in terms of their asset size. And then we also construct some cohorts. So one cohort includes one treated county that is affected by the natural disaster and each nearby adjacent unaffected control county. So we compare all the observation, all the local bank within the same cohort. So that is our, so that means we do not compare the local bank in California and New York City or Texas. We compare all the local bank just a nearby location within the cohort. That is our empirical setting. So we use the NPR size and the non-accrual loan size as after taking log as an outcome variable. And the treated is a dummy that identify the treated county that is affected by natural disaster and the control county. High MPR is another dummy that identify high MPR bank and low MPR bank. So high MPR, low MPR is identified in the pre-period. So if the MPR ratio of the bank is higher than the median value, then we assume that that is high MPR bank. And this high MPR, low MPR dummy is actually time invariant within the 2-year window. And finally, post identify the pre-period and post-period within the 2-year window. So the triple interaction term, alpha 7, is our main coefficient. So I just briefly introduce how to identify the treated and controlled counties and how to construct the cohort. So we assume that there is a 10 different county here, county A to county J. And we assume that, so this is a pre-period. So we assume that the county A is affected by natural disaster and all the other 9 counties not affected by natural disaster in pre-period. Then county A actually removed from the sample. Why? Because to become the treated or controlled county, those counties doesn't have any natural disaster in the pre-period, right? So county A is removed from the sample. In the post-period, we assume that county D and H affected by the natural disaster and all the other counties not affected. Then county D and H become the treated county because county D and H doesn't have any natural disaster in the pre-period and have a disaster in the post-period. And county B, C, E, F, G, I, J become the candidates of the control county because those counties doesn't have any natural disaster in both pre and post period. And as I said before, county A is not included because county A has a natural disaster in the pre-period. So another important condition is that the control counties should be adjacent to the treated county. So because of that, we can make one cohort like that. So county D is a treated county and county B, C, E, G are the control county. And those are not affected natural disaster and also adjacent to the county D. County A have a shock in the pre-period, so removed from the sample, and county H has another shock in the post-period. So that is not the control county in this case. And all the other one is far away from county D, so not included in the cohort in this case. Another cohort can be made here. County H is also treated county, and county E, G, I, J are the control county in this cohort because those are adjacent to county H, and all the other one is not included as a cohort in this cohort. So we can have two different cohorts. Another important one is count E and G actually duplicated that belong to both counties, both cohort. So because of that, we also assign different the cohort ID to each the count E and G. So in doing so, we just distinguish count E and G belong to the first cohort and second cohort. So that is our the method to identify treated and control county and construct the two or multiple cohort. Okay, so this is our summary statistics. So our sample period is from 2001 to 2019. So we also have data for 2020, but 2020 is a quite unique year. So because of the pandemic, so all the county in US are subject to emergency declaration by the FEMA because of pandemic. So that is quite a unique year. So we just remove year 2020 and our sample up to 2019. So the first one, NPL non-accrual, that is our outcome variable. And the other three, treated post and high NPL, those are our main independent variable. So treated is around the 28% and post and high NPL is exactly 50% observation. Become post or high NPL, or the other 50 is period, and the other 50 become low NPL bank. And all the other one is a bank level control variable. Okay, before moving forward to our main regression, so the first thing we need to do is to confirm whether the natural disaster indeed some negative shock on asset quality or solvency status of local borrower. So to do that, we relate delinquent loan ratio of the bank, local bank, and the shock dummy variable. The delinquency is delinquent loan ratio. That is the amount of delinquent loan. That is loan with the overdue of payment more than 30 days up to 90 days. That is delinquent loan over total loan amount. That is delinquency in this case. And we have a three shock dummy variable. The first one is shock current Q. So this one is a quarter end value. Delinquency is quarter end value. And shock current Q is the dummy that equal to 1 if there is at least one natural disaster in the county during the same quarter. And shock lagged Q is if there's at least one shock in the previous quarter. And shock combined Q means at least one shock, either this quarter and the previous quarter, then takes a value of 1, otherwise 0. So the results show that there is a delinquency and the shock dummy are highly positively correlated. So that means if there's a shock, then the local bank's delinquent loan ratio more likely to increase. So that means this natural disaster, indeed, some negative shock on asset quality. That is important finding before moving forward to our main result. So this is our the first main baseline regression. So log of NPL is used as your outcome variable. And the columns 3, 4, 5, those are triple interaction, triple different specification that I said before. And this two column is just a diff and diff. And we just compare different diff estimator between low NPL bank and high NPL bank. So the meaning of the first column is if the banks are low NPL bank, that is a safer bank, the asset quality is okay or good, then this bank is, if this bank faces local natural disaster in the treated county, then the bank are more likely to report more NPL in the post period. So this one is quite natural because in previous slide, you see that natural disaster, actually negative shock on asset quality. Because of that, banks have to report more NPL in post period. That is quite natural. However, if the bank's NPL ratio is high as of the pre-period, that means bank's asset quality is not very good and before the shock, then you cannot find any evidence that the banks also report more NPL after the natural disaster in the county. So this difference between two also can be captured by in column 3 as a triple interaction term. So this triple interaction term also captures the difference between the two. So in column 3, the first interaction term, treated time post, means same as this one. So that means if the banks have low NPL ratio, the bank is more likely to report more problem loan in post period. But if the banks have a high NPL ratio, then less likely to report more problem loan in the post period. Okay. Another question. And provision. If risky loan asset, it will reduce the provision, as well as NPL, as asset become unrecoverable. Okay, so this question also highly related to this one, I think, because so that means high NPL bank and low NPL bank actually difference in terms of many different dimensions. Because of that, their reporting of NPL also different. I think, yeah, so I will answer this question. So actually, in column 3, this one is also very important. So high NPL times post. So this means that, also negative, this means that if the bank have a high NPL ratio as of the pre-period, that is, asset quality is not very good, then the banks is more likely to reduce their reported NPL in post-period even without natural disaster. So that is kind of mean reversion. That means banks actually have high NPL in the pre-period. They're more likely to underreport their problem or just reduce their NPL size in post-period because the banks just concerned about their high NPL in the pre-period. Then without any natural disaster, any shock, even in the control county, the local banks in control county also reduce their NPL in post-period. So even after control for this one, our main result is negative even with the shock, right? So this one actually captures some difference between high NPL bank and low NPL bank without shock. So that is captured by this one, even after control for this kind of stuff. So I think the question in the chatting room also related this part, I think. Okay, I'm asking if it is underreporting or just actual reporting, as number of loans will become loss, will not be NPL. All right, so I need to think a little bit more about this one, how to answer this question. But anyway, so one of the important part of this setting is that, so this one also shows some difference between high NPL bank and low NPL bank in terms of many different things. So in fourth column, actually, try to control for the fundamental difference between high NPL bank and low NPL bank by adding year by, quarter by, high NPL fixed effect. So in doing so, we can compare only within the high NPL bank or within only low NPL bank. So even after that, our main coefficients still negative and significant. For example, the difference between high NPL and low NPL banks includes some risk culture, risk appetite, and the risk management system, or even regulator also push differently between high NPL bank and low NPL bank. So there are so many differences between the two types of bank. So that may affect the NPL size or report reported size of the reported amount of NPL on the balance sheet. So even after control for those unobservable differences between high NPL bank and low NPL bank by adding this fixed effect, so our main result still survive. So I will think about the question more clearly, and then I will answer the question later. And the last one, the column 5, another important unobservable issue is each county may have a different characteristics. So a certain county, richer county, a certain county, poor county. So those kind of differences, or for example, demographics or the population size, everything different. So those differences may also lead to differences in NPL size or NPL reporting pattern. So in the last column, we add year, county, fixed effect as a robustness. So in doing so, we can capture all unobservable differences across the counties. Even after that, our main result still survive and is significant. And next one, we simply replace the outcome variable from NPL to non-accrual loan, and the result is also quite consistent. And next one, we also have some robust tests for some remaining challenges, our empirical challenges. So the first one is one of the challenges, if the capital ratio and profitability are highly correlated with the NPL ratio, then we cannot confirm that the result under reporting is driven by NPL ratio, or that those results can be driven by just capital ratio or profitability. So in first robust test, we add the capital adequacy and profitability related control variable, and also their interaction with other key dummy variable as a control, and we find some robust tests, a robust result. And second one is we simply replace the dummy variable for the high and low NPL ratio with a quartile value, and the result also quite robust. And third one, as I said before, we sort the sample into more severe disaster and the less severe disaster, and the result actually more significantly driven by the cases with more severe natural disaster. So I will show you all the results on the later slide quickly. The next one is this reporting accounting management itself is management decision. So maybe the management style or the governance structure, owner structure may affect their under-reporting pattern. So the best way is to just add some control variable that captures just management style. But instead of that, we use another way. That is, we just limit the sample to the local bank that is affiliated in the bank holding company. And also we limit the bank holding company to the bank holding company with at least 3 or more the local bank in the bank holding company. And then we add the year by bank holding company fixed effect. So our assumption is that the governance structure or owner structure is actually determined by the bank holding company, and all the subsidiary local bank under the same local bank, the bank holding company actually share the same level of the owner structure and the governance structure. So, but those local banks also have a difference, some variation in terms of their NPL ratio and the treated control dummy variable. So in doing so, we can control for the management style made by the bank holding company, and then we just can test whether after controlling for the management style, the result is still robust. And actually, we find robust result. And lastly, instead of the size of the NPL and size of non-accrual loan, we use just NPL ratio as a outcome variable, and we find some robust result. So first one is we just control for the capital ratio and also profitability. So those are additional control variable, but even after that, our result quite robust. So this one also quite interesting. So if the capital ratio is quite low, the banks are more likely to underreport their problem loans. So that is quite consistent with our existing paper. But even after that, after the controlling for this part, our result are still robust. Next one is we just replace MPL dummy with the quartile variable, and the result also quite consistent. In this one, we try to sort the sample into the more severe natural disaster and the less severe natural disaster. And all of this one negative sign, but the significance is much bigger for the more severe cases, both in NPL and non-prolonged cases. And the next one is we limit sample to the local bank affiliated in a bank holding company. And also we limit the bank holding company to those that have at least 3 local banks to have a sufficient variation within the bank holding company. And also we add this one, year by bank holding company fixed effect. So we control for capture entire unobservable difference across a different bank holding company. Even after that, the result is quite consistent, at least the direction is same. One problem with this approach is our sample size shrink a lot because we limit sample to quite restricted condition. So we need to think more about this one, how to improve this part. But anyway, until now, the result is also quite consistent. And this one, we instead of the size of NPL and non-accrual loan, we use NPL ratio, year end, or the annual average as outcome variable, and the result also consistent. Another next one is, until now, our argument is that the results are more likely to be driven by the bank's accounting management or accounting discretion, but there may have some alternative method. So we try to test these alternative channels. So the first possible way is banks just change their asset structure or lending structure. That means they just shift credit portfolio from the low quality to high quality. So in doing so, banks can reduce their reported NPL. That's also possible. So we try to test that. So first we are using the mortgage data set, but within the 2-year window, the same 2-year window used in our main regression. So within 2-year window, we cannot find any evidence about significant changes of their asset structure or lending structure in mortgages, and also in small business lending. We cannot find any substantial changes in the loan structure within the 2-year window. And also the balance sheet size of asset, credit days includes the unused commitment in the off-balance sheet. We cannot find any evidence that the banks actually change their asset structure or lending structure within the 2-year window. If we extend the structure, if we extend the event window to 5 or 6 years, then we may find some changes of asset structure or lending structure for the bank with high NPL ratio after the shock. But within 2 years, we cannot find any structural changes. But in our main regression, we find that significant changes in the reporting pattern of their problem loans. So that is not driven by this kind of real management. And another way to reduce their reported problem loan is to actively, aggressively charge off their NPL. So that is also a question in the training before, but also we test that, but we cannot find any evidence that the bank with high NPL ratio actively, aggressively write off their problem loans to reduce their reported problem loans. So that's actually another question that makes another question. Then why banks do not use the charge off? That is really direct way to reduce their NPL from the balance sheet. So to answer this kind of question, we also further test. We have another further test, about this one. So we try to relate the charge-off and other financial ratios. So we find that if the banks increase their loan charge-off, write-off, then the banks also increase their loan loss provision. So loan loss increasing. And because of that, banks' profitability become worsened. And as a result of that, capital buffer also become worse. So that means charge-off increasing and other financial ratio become worsened. So the reason why the banks underreport their problem loan is to reduce the concern for the bank's riskiness, to reduce the likelihood of market discipline. But if the banks increase the charge-off to reduce their NPL, then banks actually face another bad outcomes in other financial ratio in terms of provision, profitability, and the capital ratio. This also may trigger another market discipline. So our conjecture or our conclusion is that because of that, because the charge-off itself also worsens other financial ratio, banks are less likely or less unwilling to use this charge-off to reduce their reported problem loans. So it's because of that, banks are more likely to use accounting management and accounting discretion to underreport their problem loans. That is our conclusion in this part. All right, so the last part is about, so until now we find that banks really care about their NPL ratio. Because of NPL ratio, banks change their behavior change the reporting pattern of their problem loan after the negative shock. Then why banks really care about this NPL ratio? That is another question. So we argue that this is because banks really have a concern about the market discipline. So because of that, banks try to manage their reporting pattern if the banks especially have high NPL ratio. So we want to test this one to complete the story. So to do that, we relate the bank's local deposit size and the bank's NPL ratio. So the deposit is the major source of funding of the bank. So depositor is one of the major stakeholder of the bank. So we try to relate the deposit as the bank's NPL ratio within the 2-year window. So this table shows us that if the bank's NPL ratio is high as of the pre-period, the bank is more likely to face reduction of the local deposit in the post-period. So all of these coefficients become minus and also significant. So no matter whether this is treated county and control county, the result is consistent. So that means depositor actually reallocate their money from the bank with high NPL ratio to another bank. So we can confirm that local depositor really have a concern about the bank's NPL ratio in our sample. So if the banks, the stakeholder, the depositor have a concern for the bank's riskiness because of NPL ratio, that kind of concern may be more significant in a certain period. For example, if the market stress is really high, then the stakeholders' concern for the bank's riskiness may be higher. And if the market is really competitive, the banking market is really competitive, then the stakeholder or depositors' concern for the bank's riskiness may be higher. And if the number of banks in the county scaled by the local population is smaller, then the financial ratio and performance are more easily observable by the market participant in the local area, then market discipline may be more severe or more significant. So as predicted, after we sort the sample into 2 subgroups, stress market, non-stress market, and competitive market, and concentrated market, and the market is less bank, and the market is more bank, then you can find that the market discipline or reduction of local deposit in response to high NPL ratio of the bank is more severe in the stress market and competitive market, and the market with less number of banks. Okay, so we can also confirm that the high NPL indeed likely to trigger kind of market discipline in terms of local deposit size. Then if the bank also, so banks, we also think that banks also already know this one. So that means market discipline is more severe in those markets, stress market, competitive market, the market with less number of banks. Then banks under reporting pattern, or banks response to the negative shock also different between the two types of bank, two types of market. So finally, we move back to our initial baseline regression, and then we try to sort the sample into two parts: stress market, non-stress, and competitive, non-competitive. And the market with more bank, less bank. And then we find that the underreporting of the problem loan of the bank with high NPL ratio after the natural disaster is also more significant in the stressed market, in the competitive market, and in the market with less number of bank in terms of NPL and also in terms of non-accrual loan. Okay, so the result of this one, so the result of market discipline, the local deposit size, and also the pattern of banks underreporting are quite consistent to each other. Okay, so this is all about the result. So let me conclude the findings. So in this paper, we find that the banks really care about their NPL ratio. And also not only the bank, but also market participants and banks depositors, stakeholders also really care about NPL ratio. Because of NPL ratio, the banks and market discipline change their behavior. So we conclude that the bank's NPL ratio or asset quality index also quite important driver that differentiate the banks, the loan reporting, especially problem reporting pattern and their behavior. And also this kind of incentive, banks' incentive to control the size of their reported problem loan can be a very important source underlying the growth of zombie lending by the bank. So that is our main conclusion. All right, thank you very much for your listening and also your feedback and also your question. So I also think more about the question and also what is the great answer to your question.
Yes.
So if you have another question, then please let me know.
You did answer with your subsequent, I guess. Yeah. Are you able to hear me? Yeah, so I think you did answer. Yeah. So you did take care of it and slightly on your robustness test when you do look at the write-offs, possibly like what is reported in terms of increasing write-offs. I think this does cover some of the aspects that I've asked.
Oh, okay. Yeah. Thank you. Yeah.
So I do not see any more questions in the chat box. Unfortunately, Professor Mohapotra had to take care of something personal, so he's not delivering the concluding speech. So I will be doing it on behalf of him. So thank you for presenting this paper. It's a very nice paper, and I really hope that it hits a good like outlet that you're looking forward to. I really enjoyed listening to it, and
yeah.
And hopefully you will come back again to Mishra Center to deliver some other speech in future.
Oh yeah. Thank you very much for your comment and feedback.
Thank you for thanks to everybody who has participated, and thank you everyone. Yeah, for organizing. Okay.
Okay. Thank you very much. So
thank you so much.
So really, I also hopefully visit there physically next time and meet the people there.
Yeah, we'll be glad to host you. Yes, if you can.
Yeah.
Yes.
Thank you very much. Thank you. And right, thank you. And if you have any other further question or the feedback, please email me here, and I also try to answer and also try to reflect on my paper when I improve this paper. All right.
Thanks, Kevin. Thank
you. Thank you very much.
Yeah.
All thank you. Yeah. Bye.
Thank you. Bye. Hello, Harshit. Yes, sir.
I think we can stop recording.
Okay.